Good morning and welcome, and thank you for joining our coronavirus presentation of Stormy Markets Calming Advice. My name is John Eaton and I'm one of the managing partners with Anchor Pacific, and I'm joined on this webinar by our CEO, Steve Adang. But before we get started, I'd like to cover a few housekeeping items. First, this call should last about 25 minutes, during which all the participants will be on a listen-only mode. Should you have any questions, please jot them down and email them to us or phone us after the presentation. We'd love to hear from you. This presentation is being recorded and we will make it available. We'll actually be sending a follow-up email with a feedback form, a link to the recording, and a list of resources to help you through this crisis. Our lawyers have also asked that we mention that this presentation is not a solicitation to purchase any securities. So what's going on? Well, we'd like to accomplish three things today with this seminar. First, we'd like to help you gather some perspective about the crisis. We'd also like you to learn why you need to have some understanding of your investment portfolio and your exposure to risks. And three, we'd like to give some guidance as to steps you can take right now to help you through this crisis. We know that things in the world are changing by the minute. So we felt it important to give some perspective and guidance through this. I mean, we've been through market issues before. Both Steve and I have over 20 plus years experience in preserving capital through uncertain times. So as this call is really an extension of a similar call we delivered with clients on Friday, we hope you find it very informative. So we were prepared for this volatility, both from a portfolio perspective and a business continuity perspective. We remain fully operational, and we're ready and able to assist and advise where needed and where we can add value. We continue through this to focus and deliver on our priorities: the safety and well-being of all employees, our clients, stakeholders, and their families and loved ones. The coronavirus has changed the world. This situation has moved rapidly from something that was going on over there to a full-blown global health and economic crisis, all seemingly overnight. Everyone's business and net worth has and will continue to be impacted. Social distancing means business revenues are falling and will continue to fall. For business owners, this is compounded by the drop in value of savings and investment portfolios. How long this bear market will last is anyone's guess. And frankly, we prefer to leave predictions to others. We don't know how or when the future will unfold. We don't have proprietary information, expertise, nor the ability to influence broader markets. But what we do have, and what we have spent, is time worrying about and preparing for risks to our clients' capital. However, we are confident, and as we're beginning to see in China, eventually this will pass and ultimately business revenues and your portfolio will recover. We believe this is a 9/11 type event. The pandemic is a shock affecting people's daily lives and spending patterns. It also undermines confidence and one's sense of personal health safety. But it is not yet a financial and monetary crisis, although we are monitoring the financial system for signs of stress. Instead, this is a wake-up call, because maybe risk was not a priority, or maybe out of sight, out of mind. It's suddenly become paramount to chart a way forward. The steps you take from here are of critical importance, knowing what to do and what not to do. We are here to help you understand your portfolio risks, the risks of falling short of your financial plan, and what adaptation this environment is dictating, so that you survive and thrive in the future. So I'd now like to pass it over to Steve. Steve, please go ahead.
Thanks, John, and thanks to everyone for joining this call. I'm Steve Adang, and I'm the founder and chief investment officer of Anchor Pacific. And so we've been pounding the table on risk management for many years now. And while it seems like the whole world has been focused on return at all costs, we've been structuring portfolios to manage risk for our clients. Last June, we wrote to many of you an article that we called Next 10, where we said that the returns of the past 10 years were highly unlikely to be rolled forward into the next 10 years. And that was due to high late cycle equity valuations and a stretch for income. And while we didn't necessarily know that this virus would take on the life that it did, and we didn't know what would trigger increased volatility, we knew it would inevitably occur, and we were prepared. We protected client capital during the sell-off, and our portfolios have performed as we would have expected them to do so. And this was a result and a testament to our culture and the embedded structure of our firm, our systems, our framework, our process, the way we think. Our firm's philosophy in its simplest terms breaks down to client first and risk before return. What you see next is the view from an eagle's perch. And the accompanying quote is, when you work in the trenches, all you see is the sky. So what is required here in finance is an eagle's view, and it allows you to make connections and linkages with respect to finance, money, the flow of capital, and history. And the reason it's important is because in this industry, many workers toil in the trenches and they fail to see their surroundings. We feel that this view, which has been garnered from a wealth of experience, is highly beneficial to our clients, particularly in crisis times. And so our experience in particular, John and I have 20 plus years in the business, him from the private client wealth side, and myself from the institutional trading side. And my point is that this isn't our first crisis and it won't be our last. So I'd have to look back and start and say, well, the Asian devaluation in 97, the Russian defaulting on its debt in 98, accompanied later on by the implosion and the leveraged unwind of long-term capital management, the Y2K scare, the dot-com implosion, of course, 9/11, which we spoke to, and the global financial crisis of 2007 and 2008. So we haven't seen one for a long time, but we've got one here. And then I think lastly, what we add is our highly technical level of investment expertise and specialization. So how are we helping our clients today, right here and now? So we just want to let you know that we are a resource. Use us as that, and as a strategic advisor and partner. We are here to deliver accurate information, to provide unbiased advice, to act with accountability, to be that one watchful eye, and to maintain discipline to keep our clients to well thought out plans. We believe right here and right now, this volatility is back and it's here to stay for some time. This is a paradigm shift, and properly executed diversification and risk management have and will continue to be your best tools in this environment. There will be good opportunities going forward. We can't say for sure whether this is the bottom, nor do we plan on forecasting it. It's not what we do. But what we will say is now is a good time to rebalance for those that have been fully invested, to dollar cost average into equities for those with excess cash who had been underinvested and have sufficiently long time horizons. As I said, our systems, our framework, and our process have prepared us for this volatility. The time to prepare is not during the emergency or after it, but beforehand. And we're sleeping reasonably well at night in this regard, mainly because we lost sleep long before this in thinking about and planning for these types of scenarios. So there's ample academic and practical evidence that many features of investment management are overvalued or of very little use when all is said and done. We believe that individual stock picking in the context of a fully integrated portfolio management and financial plan adds little to no value. We also believe market timing is next to impossible. And no matter what one does, you'll never be able to diversify 100% of your risk. Otherwise, you'll earn a 0% rate of return. Intelligent diversification works for us and our clients, and it's because we fully understand all of our portfolio's risks, exposures, from the pattern of these returns, how they interact with one another, and the underlying holdings. So some of the risk exposures that have provided relief to client portfolios during this time have been gold as a store of value, a structural exposure to the US dollar, a tactical exposure to the yen. These are macro trades that generally benefit in what is known as a flight to quality. Similarly, our exposure to long-term interest rates in the form of US Treasury bonds as yields have approached zero. And lastly, absolute return and actively managed strategies that have been exposed positively to increased volatility. So what does this mean for your investments today? So in the last 10 years, equity markets have been fully valued for some time as investors have indiscriminately chased return and income with little to no regard for risk. Also, investors have a false sense of diversification. Where are we today? 2020. So year to date, equity markets are down about 30%. Small cap companies are down closer to 40%. Balanced portfolios should be down about 15%, more or less. I would say plus or minus 2 percentage points. So if you're in that area, you're probably where you're supposed to be. But more investigation is warranted. And one of the things that you need to be aware of are lagged valuations for assets that may be marked to model. These are generally with respect to private investments and mainly private equity instruments. So investments in a portfolio of privately held companies. And so many of these do not mark to market because there isn't price visibility. And so they would either be held at cost or to some theoretical model-driven price. But with small caps down 40% in value, I would argue, and I don't think anyone would stand in my way, that the value of private businesses today, if they had to be sold, are probably about 40% less than they were at the beginning of the year. And so the question that you have to ask yourself right here and right now is diversification as you know it working for you? So in further questioning your portfolio, you've got to perform a critical assessment. You've got to know what questions to ask. And you've got to find someone who can help you get these answers. So some of the things that you need to be looking at are what do you actually own and what are your true risk exposures? And you're going to have to look through the actual instruments themselves. What are the potential blind spots you should be aware of? And how much liquidity do you really have? So one of the things that we think is going to be critical going forward is your ability to access your investments if you have the need for cash. This is going to be a wake-up call for many of you. So in terms of exposure to riskier assets, you can look to the breakdown of your holdings in public versus private companies. You can look at your exposure to small cap companies, which are generally more exposed to the business cycle. You can look at cyclical companies versus defensive companies. And you certainly want to be looking at your exposure to energy with oil at $20 a barrel. Here in Canada, many Canadians have home country bias. that means that you own more Canadian equities than the Canadian share of either GDP or worldwide stock market capitalization. And you have a Canadian equity market that is highly concentrated to energy, financials, and materials, which could create some imbalances from an asset allocations perspective. You also want to be monitoring your exposure to companies with weak balance sheets. In other words, highly leveraged companies that from the equity, both the equity and the credit side. You want to look at your exposure to the real estate sector, which is generally leveraged and cyclical, as well as your investments in mortgages and other direct lending products. So some of the potential blind spots to be aware of, we've mentioned these: seeking return at all costs, herding into income products, the mark-to-model masking underlying risk in privately held companies, which is translated to a mispricing of illiquidity, and then the diversification question. So I would argue that many portfolios are under-diversified or not properly diversified. And I would also argue that many investors have a false sense of diversification and how it's going to work for them. So this is a critical time for many of you. Now is the time to assess or reassess everything about your finances, your financial plan, your business plan, your capital structure, your succession plan, your portfolio, and to really evaluate your team of advisors. And if you don't have one, to strongly consider forming one. Many of you are well structured already, and your adjustments may need to be minor ones. Some of you are just getting started, and this is a great time with the recent events serving as a catalyst to move forward. And some of you are going to require more work with your plans and your portfolios. We're here to help you. And for that, I'll hand it over to John to wrap up.
We'd like to conclude this webinar with a little perspective and lay out a suggested plan of action for you. So first, for perspective, if we stop for a moment and set aside the natural fear and social anxiety caused by this global spread of the coronavirus, and we objectively chart the spread of the virus and disease, three things become apparent. One, it spreads very quickly. Two, its effects can be contained by aggressive social isolation and quarantine. Three, the population recovers and things start to normalize. So we in North America are basically just starting stage 2. People are starting to work from home. The streets of San Francisco are empty. Times Square is almost empty. But we do know that following through on social isolation brings about stage 3. China is experiencing this now. Things do recover and the sun does rise again. So second, what should we be doing now? Well, we think there are 3 general categories. The first is mitigate the effects of this current market on your net worth. 2, ensure you have a recovery plan. 3, figure out how to avoid repeating mistakes. So we suggest a 4-step process to implement this. Step number 1, mitigate your current risks. Do this by asking your financial advisor for a risk evaluation of all your holdings. It should cover, at a minimum, the risks that Steve was just speaking about. And the easiest way to accomplish this is by giving him a risk matrix. Now, we can help you with one should you ask. Step number 2, determine which risks you are uncomfortable with and remove them. So look particularly for risks that overlap between your business and your portfolio. So step number 3, ask your advisor for a recovery plan. This should be written and in detail. Step number 4, as the economic outlook improves, do a post-mortem. This involves evaluating your financial plan. Examine the results of this health crisis on your net worth. Examine your business, real estate, and investment portfolios. And ask yourself, are you still on track or not? B, evaluate your balance sheet and capital structure, looking for any unnecessary risk exposure. And C, honestly assess the approach you and your advisors have taken, and look to adopt an approach that avoids getting caught again. And finally, we feel it's very important to adopt a risk-first approach. So if you follow these 4 steps, this should give you, in times of uncertainty, a game plan and a track to run on. It will increase your peace of mind and save you some time figuring out what to do. We actually have a checklist of questions you should be talking with your advisor about today that we can include in our survey email we are forwarding to you. So, in conclusion, thank you for calling in. We've covered a great deal of information, and I'm sure you have some questions. So please follow up. We can be reached by email and by the phone numbers below. So again, on behalf of Steve and myself and all the rest of us at Anchor Pacific, thanks for calling in. And remember to follow the instructions our federal and provincial chief medical officers give. Practice social isolation, and look after yourself, your employers, and your customers. Thank you very much.